Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by. Well, hello. I'd like to invite you to another episode of Keep Hammering Until It's Finished, your DIY channel for all things home renovation. Yeah, just kidding. I want to welcome everyone to Thanksgiving. Hey, Q3 models out for the portfolio tool that we've been using modern portfolio theory. I'm shooting here in my friend's basement. They're still working as I'm traveling for Thanksgiving, so hope all is well with you wherever you are. Let's look at the model real quick, as we like to do. Okay, so just like always, I put the Q3 up here. These dates are as of, I got a late jump on this, but it's basically November 1. So I downloaded, it's from 5 years, December 2018 to November 2023. So that's your 5-year window. I know it didn't quite capture exactly the exact end of the quarter, but like usual, we have our all of our sectors here, and we added gold and large indices for those who are new to this, as well as a few bond funds. So this is kind of the collection of all the terms here, and as you can see, we have about 40% in bonds the way I ran it, about 25% in whatever this is, gold and large indices, and 35.5% in information technology. So if you want to go and see, well, what are the exact ETFs, these are all ETFs. It's color coded, and so this is conditional formatting. If there's any money in it, this will turn yellow. So I know it's hard to see, but this is VGT. We just did a video on this, as it seems like it's going to be highly favored in this model, in this approach. So again, if you're new to this, these are all highly liquid sector ETFs. So energy, these in materials, industrials, consumer discretionary, and as you can imagine, it just keeps going. Emerging markets, ex-China, GLD. It's the gold, it's like the spot gold ETF. SPY is the S&P 500 ETF, and VTI is the all US equities ETF. We have PGHY, so it's even hard for me to remember this one because I've never owned it, and it's not been yet selected by this model. But this is a high grade or high yield. You can see at the end the HY is the high yield. And then this other one is it's an investment grade bond fund, corporate bond fund. So anyways, so this would be the junk, the one that ends in HY, and the other one would be investment grade corporate bonds. So what ended up happening in this model, the way that I have it this week, depending upon the return, I think I went with a 10.25% return. In the way I worked this out was about 40% in the SHY. So there's comments here you can read and try to figure out if you want to use SHY, like a really short-term U.S. Treasury bond fund for your risk-free asset, which is what we use a lot in this. Or if you're a longer term, you might want to consider switching that over to TLT. What I mean to say is, when I was in graduate school, they really talked about the ultra short, the 1 to 3 month, 1 month, whatever, U.S. Treasury. But as I've gone through the CFA program, there's been more chat about maybe using a longer U.S. Treasury. Anyway, so again, if you need a full walkthrough on how to use this model, you can watch it here, YouTube. It gives you all the different ways to use the solver tool, which is mentioned here in step 2. So step 1, you're going to want to pick your basically your return that you'd like to get, and here are some of the average returns that have come with some of the bigger indices: the S&P 500, the Russell 2000, the MSCI World Index, and VTI that we just mentioned before. I'll give you a little one-sentence write-up on what those are. Step 2 is really, you want to do the following steps. You're going to click on this data here. I know there's 2 datas. It's kind of weird, but the data that's on your Excel sheet. And then you're going to open something over here. It's always on the far right, called Solver. And so that's what they're talking about here. If you don't find Solver or data analysis listed, just Google it about how to pull it up on your Mac. Yep. And so this is really going to be there's going to be a rule in here, and you'll want to change it to 0.1025 for my 10.25% return. give me the best 10.25% portfolio that we can make based on what we know, based on this model, looking back at 5 years of performance for all those assets. And but maybe you don't want 0.1025. Maybe you want 0.12, 12% return. It maxes out at, I'm going to cancel this. And once you get your number in here, you could just solve it. If there's more little rules that you could add to kind of custom make this, but if you want the whole breakdown on how to do that, just click right here and it'll talk about all the different rules and things that you can come up with and how to change them. We are doing this, which we talked about before, but this is the kind of the investment horizon. And so these are all our different assets kind of plotted out. These don't actually go with the one we're looking at, so this graph is just an example. But what we want to do is try to find this optimal amount here of the risky assets that are all going to fall below this dark blue line, or on the dark blue line or below. And then if we don't like this much risk, we're going to come down this white line to kind of bring down the risk. And the way that we would do that is maybe we want to be somewhere in this range. So trade off, get rid of a little bit of risk and get rid of a little bit of return and come down this line this way. Maybe we'll put something like 80% of our money here in this orange dot and 20% of our money in the risk-free, and you can imagine that that would move you along this white line. So we go over this in our full course that's on premiersteadyinvesting.com. If you'd like to add all kinds of different things besides what I have in this model. For example, someone said, well, what happens if you add Bitcoin? I said, I don't know. I said, I don't have Bitcoin in the model. And maybe Berkshire, I don't know. There's all kinds of assets that specific individual assets or individual companies I don't have in this. So if you want to make your own, you can use our portfolio creation course to kind of custom make and understand what I'm doing behind the scenes. But if you're just going to go with this, you can imagine that if this is the best portfolio of all your risky assets, and then you want to kind of do an 80-20, 80% here, 20% here, it'd bring down your risk and it would actually bring you down along this white line. So thankfully, this did not turn into a construction, home, do-it-yourself, remodel channel. We're still doing finance. So, okay, thanks so much. Bye.